Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my Mind Over Markets video presentation for Friday, December 2nd. To view our full range of trading services, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Conflicting economic data continue to bedevil investors. In response to softening inflation numbers, the Federal Reserve makes dovish noises and stocks soar. But then the labor market shows surprising strength and stocks slump. We've enjoyed solid stock market gains in October and November, and we perhaps stand on the cusp of a year-end Santa Claus rally. But regardless, it's going to be a bumpy ride. Let's parse the latest economic data. Non-farm payrolls increased 263,000 in November, while the unemployment rate was 3.7%, the U.S. Labor Department reported Friday. The payrolls number far exceeded the 200,000 estimate. The unemployment rate was in line with expectations. Leisure and hospitality led the job gains, adding 88,000 positions. Average hourly earnings jumped 0.6% for the month, double the estimate, and 5.1% annually, compared to the expectation of 4.6%. Both the labor force participation rate at 62.1% and the employment population ratio at 59.9% were little changed in November and have shown little net change since early this year. These surprisingly strong employment gains have occurred despite the Federal Reserve's aggressive interest rate hike cycle this year, which has brought the Fed funds rate to 3.78%. On Thursday, the BEA reported that the core personal consumption expenditures PCE price index rose 0.2% in October, below the estimate of 0.3%. The core index, which strips out volatile food and energy costs, increased 5% year over year, down from 5.2% annual rate in September. That compares to the 40-year high of 5.4% last February. The S&P 500 reported year-over-year growth in earnings per share of 2.4%, the lowest growth rate since Q3 2020. 70% of S&P 500 companies reported actual EPS that exceeded estimates for Q3, below the 5-year average of 77%. Inflation may be showing signs of cooling, but it still preys on the minds of corporate managers. The term inflation was mentioned at least once during the earnings conference calls of 398 S&P 500 companies from September 15 through November 28. The energy sector reported the highest year-over-year Q3 earnings growth of all 11 sectors in the S&P 500 at 137%. The energy sector reported the highest year-over-year revenue growth rate of all 11 sectors at 46.9%. Corporate earnings have stayed aloft, yes, but growth is decelerating. In fact, if you remove energy from the overall equation, the S&P 500 as a whole would come in negative for Q3 earnings growth at minus 5.3%. Higher year-over-year oil prices contributed to the year-over-year improvement in revenues for this sector, as the average price of oil in Q3 2022, $91.43, was 30% above the average price for oil in Q3 2021, $70.52. 61% of S&P 500 companies provided EPS guidance for Q3 above the 5-year average of 60%. Despite some of these economic headwinds, surveys show that corporate managers are increasingly less fearful of an impending recession, and that bodes well for 2023. There was a 26% quarter-over-quarter decline in the number of S&P 500 companies, citing the term recession on earnings calls for the third quarter, 179, relative to the second quarter, 242. Jobs and wage growth suggests that consumers will continue spending, especially during the crucial holiday season. Adobe Analytics predicts that U.S. online holiday sales will reach $209.7 billion from November 1 to December 31, representing a year-over-year increase of 2.5%. That may seem like lackluster growth, and it is, but considering economic headwinds, it's remarkably resilient. But the strong employment picture also tells us that the Fed will be less inclined to make a dovish pivot when it meets this month, despite recently encouraging data that show inflation on a downward slope. We're approaching Christmas amid economic crosscurrents. We'll see if the final month of 2022 will be naughty or nice for investors. In the meantime, if you're looking for a way to generate steady income, consider our premium trading service, Rapier's Income Accelerator. helmed by our income expert, Robert Rapier. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. And if you have any questions or feedback, please don't hesitate to send me an email at mailbag@investingdaily.com.